What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. So last episode, I showed you how the short-term rental tax loophole works. That's the 7-day rule, material participation, and the math behind potentially saving $30,000, $40,000, $50,000 or more in a single tax year. So we're going to continue our series today with part 2. So today I'm going to talk about something a bit different. We're going to flip it a little bit because as powerful as this strategy is, I see investors constantly blow it up, and it's almost always the same handful of reasons. So people who did everything right buying the property, set themselves up perfectly, then left all this money on the table in the form of taxes because of one or two completely fixable mistakes. So today we're going to go through the 7 biggest mistakes short-term rental investors make at tax time. And a couple of these, they're ones even experienced investors get wrong or mess up from time to time. So whether you're brand new to short-term rentals or you've been doing this for years, just stick with me and let's get into it. So real quick, for anyone who's joining us for the first time in this series, go back and listen to last week's episode on short-term rentals for the full breakdown. But here's the quick 1-sentence version. If your short-term rental averages 7 days or less per booking and you materially participate in running it, you can generally use your short-term rental losses to directly offset your W-2 or business income. So that's the strategy. And the mistakes I'm about to cover are the things that prevent investors from qualifying for it or using it to their best advantage. And it costs them money even after they qualify otherwise. So let's go through them one by one. So number 1, this is assuming you qualify without doing the math. Now, the first mistake here is, this is the one that happens before anything else, assuming you qualify for the short-term rental loophole without actually verifying it. And I get it. You're on Airbnb. You might think, well, most of my guests stay only a few nights, so I'm probably under the 7 days. But probably is not good enough when you're talking about a tax strategy that you're relying on to shelter tens of thousands of dollars. So remember, a 7-day rule is based on your average rental period, not your typical booking, not your most common booking length, but the average. And averages can be skewed. So you have, a handful of longer bookings, like a couple 10-day stays or a few 2-week bookings in the summer. That can push your average over the line without you realizing it before it's too late. So the fix is simple. Do the math. Pull your booking data from Airbnb or VRBO or wherever you're hosting. Add up your total rental days. Count your total number of separate bookings and divide. If you're under 7, great. If you're right on the line, you should consider how to manage your bookings through the end of the calendar year to make sure you don't go over 7. And if you're over, then the loophole's not going to apply for this year. And it's critical you know that before you file. So don't assume, make sure you verify. Now, number 2, using a full service property manager. So I talked about this one a bit in episode 1, but I'm going to say it again here because it is, without question, the single most common reason that investors fail to qualify for this strategy. If you hire a full service property management company that handles all the day-to-day operations, guest communication, booking management, cleaning coordination, maintenance coordination, all of it, then you almost certainly do not materially participate. And if you don't materially participate, the losses are passive. The strategy doesn't work. Now, I want to be careful here because I hear investors sometimes take this too far in the other direction. They hear this and think, okay, so I can't hire anyone. And that's not what I'm saying. You can absolutely hire help. You can have a cleaner. You can have a handyman. You can have a co-host that helps with check-ins when you're traveling. What you can't do is hand over all of that entirely and expect the IRS to consider you as materially participating. So the test is this. Are you the one spending the most time on this activity? More hours than any single other person involved? If the answer is yes, genuinely yes, and you can document it, then you're in good shape. If a property manager is logging more hours than you are, then you're not, and you're not going to be able to use this strategy. And then here's just another hard truth for some people. The short-term rental loophole and fully passive ownership are not compatible. You have to make a choice. Either you're actively involved and you get the tax benefits, or you're hands off and you don't. There's no version where you do nothing and still get the tax benefits from the strategy. So let's go on to number 3. So this is having no contemporaneous documentation. So this one's a little sneaky because it doesn't feel like a mistake while you're making it. It only becomes a problem later, often several years later when the IRS comes knocking. So the mistake is failing to keep contemporaneous documentation of your material participation. In other words, you're not keeping a real-time log of your hours and activities throughout the year. So here's what happens. An investor qualifies for the short-term rental loophole, claims the losses, life goes on. 2 years later, they get an IRS notice. The IRS examines their return and is questioning whether they materially participated. And the investor goes to the CPA and asks them, what do I need to show them? And their CPA is going to tell them you need a log of your hours and activities for that tax year. So then the investor has to try to reconstruct from memory 2 or 3 years later, every hour they spent on their Airbnb, every guest message, every cleaner they coordinated, every maintenance call they handled. And the IRS is already skeptical of reconstructed time logs. Courts are very skeptical of reconstructed time logs. It's not that they're impossible to defend, but they put you in a much weaker position than contemporaneous records that were kept in real time. And the fix is simple. Open a Google Sheet. You can do it right now. Every time you do something related to your short-term rental, respond to a guest, schedule cleaning, update your listing, whatever it is, write it down, write down the date, what you did, and how long it took. That's it. That's your documentation. Doesn't have to be any special system. You just need to be consistent, do it throughout the year, not all at once when you get an IRS notice. Now, the next mistake, number 4, this one is working with a CPA that doesn't specialize in real estate. So, I'm not here to throw other CPAs under the bus, but real estate tax is a specialty. It's not something that comes up in a typical general practice. Most CPAs have clients across many industries and various situations, and they're really good at what they do. But the nuances of the short-term rental loophole, cost-saving studies, passive activity rules, real estate professional status, 1031 exchanges, all these real estate related things, they're areas that require a deep specific expertise that most general practitioners simply don't develop because their client base doesn't demand it. So the result is a lot of investors are working with CPAs that will competently prepare their tax return, but they're not going to proactively bring up things like the short-term rental loophole. They won't suggest a cost-sake study or map out a multi-year strategy. They'll just file what you give them and move on. And to be fair, that's typically how their business is run and what people expect. Now, I hear this from clients all the time. So I've had so-and-so CPA for 10 years. He's great, but he never mentioned any of this to me. And I believe them. Their CPA probably is great for a W-2 earner with a simple tax return, but for a real estate investor trying to legally minimize a 6-figure tax bill, you really need someone who lives in that world and does it all the time. Now, the action you can take here is pretty simple. If your CPA hasn't brought up the short-term rental loophole and you own a short-term rental, just have that conversation. Ask them directly. If they can't explain it to you clearly, it might be time to get a second opinion. Now, mistake number 5. This one is ignoring depreciation recapture planning. So this is more of a long-term mistake, but it still causes real pain for those investors that don't plan ahead. So when you use the short-term rental loophole, especially when you layer in a cost-sake study to front-load your depreciation, you're generating large deductions in the early years of owning the property. And those deductions, they reduce your taxable income now, but they don't disappear. They create what's called depreciation recapture. So a short version of how recapture works, when you eventually sell the property, the IRS essentially says, hey, remember all those depreciation deductions you took? We're going to tax a portion of your gain that's attributable to that depreciation. And it's going to be taxed at a higher rate than the capital gain appreciation. So if you took $100,000 of depreciation deductions over the years, a significant portion of your sales proceeds is likely to be taxed at that recapture rate. That could be ordinary recapture. If you had a cost-sake study that broke out 5 and 15-year property, tax at ordinary tax rates, or when you're talking about the building itself, then that recapture rate is your ordinary income tax rates up to a cap of 25%. Now, does this mean you shouldn't use a strategy? Absolutely not. The time value of money is real. Getting a $40,000 tax reduction today is worth more than paying a recapture bill 10 years from now. Plus, there are strategies like a 1031 exchange that can defer or minimize recapture entirely. But here's where investors make the mistake. They don't plan for it. They take the deductions, enjoy the tax savings, and several years later when they sell, they're truly shocked by the tax bill. So the exit strategy really needs to be part of the conversation from day one. And it could be as simple as, hey, I don't plan to sell this. I'm going to keep this property. If anything, I'll exchange it. But if your advisor isn't talking to you about what happens when you sell, not just how to maximize deductions today, you're not going to get the full picture. So just make sure you understand how everything works together. Now, on to number 6, mixing personal use and rental use. So this one gets a lot of short-term rental investors who also personally use their property. If you have a vacation rental that you also enjoy with your family, this one's going to apply to you. So there's a rule in the tax code that says if you use your rental property for personal purposes for more than 14 days during the year, or more than 10% of the total days it was rented at fair market rate, whichever is greater, the IRS treats it as a personal residence for tax purposes. When that happens, a different set of rules kicks in that limits your ability to deduct rental expenses. So here's a scenario I see quite often. Someone buys a beach house on the coast, rents it on Airbnb most of the summer, then they take their family there for 3 or 4 weeks. They're thinking they can deduct everything, all the depreciation, all the expenses, and we have to explain to them personal use days have triggered the residence rule. Your deductions are now limited, and you're not going to see that benefit. Now, this doesn't mean you can't use your short-term rental personally, but you need to know the rules before you do. Track your personal use days carefully. Understand that days spent working on the property, doing repairs and maintenance, generally do not count as personal, but days you're there for any personal enjoyment do. So the basic moral of the story is if you're staying at your Airbnb property, track those days. Make sure you track every single one. My advice, if you're using the cost seg and bonus depreciation in year 1, whatever year you're doing that, do not use your property personally at all that year. Now, number 7, waiting until tax season to think about this. Now, this one would be most important of all, waiting until tax season to think about your tax strategy, because in reality, by the time your CPA is sitting down to prepare your return in March or April, everything that could have been done to optimize your tax situation has already been decided. The year's over, the hours have or haven't been logged, the property management decisions have been made, your personal use days have come and gone. Tax preparation is looking in the rearview mirror. Tax planning is looking through the windshield. They're completely different activities, and most investors only get the rearview mirror version. So those investors that get the best outcomes are the ones that have a strategy conversation sometime early in the year or throughout the year, often before they even buy the property. So they know going in what they need to do to qualify. They set up their documentation systems on day 1. They structure their management approach correctly from the start. And at tax time, there's no surprises. So if you're listening to this in the first half of the year, you still have time. If you're listening in Q4, you have a short window. If it's after December 31st and you haven't done any of this, well, you can sometimes minimize the damage, but there's not a whole lot you can do after December 31st to really maximize your tax savings. Just tax planning is really, it's a year-round activity. It's the difference between paying $50,000 less in taxes or wondering why your tax bill is so high every April. So that's the 7 mistakes. So let me ask you to do something before I get to the action steps. Just go through the list in your head and be honest with yourself. How many of those 7 actually apply to your situation? 1, that's fixable. 2, still fixable. 3 or more, there's a signal that maybe you need a more comprehensive strategy conversation, not just a tweak here or there. Because every single one of those mistakes is fixable if you catch it early enough. None of them are fatal by themselves, but leaving them unaddressed is how investors consistently underperform on their tax strategy year after year. So 3 action steps before we go. Number 1, do an honest self-audit, run through the 7 mistakes, actually pause the episode if you need to and identify which ones apply to you. Be specific. What mistake? What's the fix? Write it down. Step 2, look at your property management structure. If you have a property manager, pull your contract, review what they handle. Is there anything you can take back, even if it's just 1 or 2 things to establish more active involvement? Something as simple as handling guest communications yourself can really make a difference in how your participation is documented. And if you're considering hiring a property manager and haven't yet, structure the arrangement carefully before you sign anything. And step number 3, if you identify 2 or more mistakes on that list, book a call. This is in a situation where you read a few articles and patch things together yourself. A single strategy session with someone who specializes in real estate can help identify problems you didn't know you had and opportunities you didn't know existed. So you can head to our website, thepurelosgroup.com, or there's also a link in the show notes. And I want to end with this. The good news is every single mistake we just talked about is one that I have seen people fix. Investors who were doing everything wrong, who restructured their approach, went on to use this strategy exactly the way it's supposed to work, None of it's out of reach. The difference between investors who pay a lot in taxes and those who don't isn't intelligence, it's awareness and timing. So now you have the awareness. What you do with it, how quickly you act is up to you. And then next week, we're going to, a little different, we're going to walk through a complete case study of real numbers from property purchase to the tax return, talking exactly how the strategy played out and what the savings looked like. So I get asked about this a lot. So we're going to do that on the next episode. Make sure you subscribe so you don't miss it. And share this episode with a fellow investor if it hit with you. And as always, if you want to walk through your specific situation, check out the link in our show notes and book a call. Until next time, have a great day. Thanks for listening to the CPA Zone. Before you go, a quick note. This podcast is for educational and informational purposes only and isn't tax, legal, or accounting advice for your specific situation. Everyone's facts are different, and you should consult with your own advisor before making decisions based on anything discussed here. If you'd like help applying these strategies to your own real estate business, we're currently taking on new clients. You can get started by completing our intake form. There's a link in the show notes. If you found this episode helpful, please subscribe and leave a review. Talk to you next time.